Hi, it's Steve Gresham from Next Chapter. We are here at EY headquarters in Manhattan West in New York City. I am here with my partner today, Nalika Nandiyakra from EY. Thank you for being here. Thanks for hosting us.
Very happy to do it. Thanks for arranging this, Steve.
Yes, well, and you were with us from the very beginning.
Yes.
So Next Chapter is 3.5 years old now, and so we're rolling into our 4th year, and we're having a ball. So one of the things we want to accomplish here today is to pick apart this concept of innovation. We are all about organic growth, trying to maintain that growth in an industry. I think wealth management in particular has stalled that organic growth. Asset management, we know, other than a lot of passive strategies, has not had organic growth for some time as an industry. So we're going to dig into that. I think as we talk about with these different topics today, and we catch all of these different leaders that we have corralled to join us here, I think it's going to be worth your time. If you're not able to stay through the course of the whole 4 hours, this session and all the sessions are recorded. It'll all be recorded together. You'll get a reminder email after the fact to check in and access that recording. So, and if you got anybody that you know that has not attended so far in any of our programs or would like to attend today, scoot that link over to them. It's never too late. And of course, they will also get the recording. So anyway, so what I'd like to do to first take advantage of the fact that you are here as the managing partner in charge of pretty much all financial services, everything in the Americas.
Consult.
Okay, and that's, well, yes, the auditing thing is not as much interest to me, but the consulting stuff. So your perch is extraordinary, working with companies. And one of the questions we get a lot is, what is the role of some of these concepts of chat, artificial intelligence? And I know that you spend a lot of time bringing that to the ground, not just up in the ether. So maybe give us the highlights of what you're working on today.
Yeah, so look, I mean, you talked about inorganic growth. The industry itself is going through a market downturn. And if you look, fees have raised to the bottom. Client expectations have gone much, much higher. So essentially our clients want a lot more, a lot less, right? So there has to be some kind of new ingredient to change the equation here. Typically, our clients tend to invest in 3 areas: growth, efficiency, and risk mitigation. I would say over the last 12 to 18 months, more focus on the latter, which is efficiency and risk mitigation versus growth. But there's probably still a few areas that's being invested in for growth. One is platform modernization. And a lot of what our clients are doing is really creating the pipes and the data and building the foundation to take advantage of AI. As you said, AI is ubiquitous, right? It's like the new digital. In 3 to 5 years, our industry will look very different. Co-pilots will be commonplace, but that's in the future. So today, what our clients are doing is investing to build the foundation to take advantage of these tools as they come down the pipe. The second piece I would say is advice effectiveness and productivity. There's a lot of areas, particularly related to knowledge management, content management, that's getting investments in terms of making advisors more productive, things like chatbot. And I would say there's also investment in client experience. Now, I make a big distinction between functional personalization and client personalization. I would say the personalization that's getting investment right now is more direct indexing, tax solutions, sort of things that clients were not getting bundled in with their typical products and services and advice beforehand.
Interesting. So like an awful lot of innovations, and I think maybe something to do right at the start here is to say that innovation does not have to be some great, big, explosive new rocket ship. Sometimes, for most of the companies, I think that you're working with the larger scale companies, I can say from my experience working with big companies, that sometimes it's that incremental improvement, that little thing, because of the enormous scale of some of these organizations. So not to count out that little idea that came through from somebody in a process somewhere that actually took some of the friction out of the relationship. Is that fair?
Yeah, I think small things that have a big impact is particularly when you think about, you always talk about, hey, everybody focuses on 20% of the clients, not the 80%, right? if you are talking about the 80% of the client, the name of the game is scale. And in order to serve those clients well, in a way that you actually have a relationship, not in a way that's one size fits all, commoditized, you have to have small things that work well that can be scaled.
Sure. And then maybe one last question. We talked about some more things. Is from the perspective of companies and their guidance and what they're looking at, one of the things that you and I talk a lot about is this consumer that's out there. And the consumer continues to pull the train, but it's almost sometimes like the industry and we fight that. So do you see something in that area of personalization that you talk about?
So this is one of my favorite topics. So I'm glad you asked me the question. I think as an industry, our view of personalization is flawed. I'll tell you why. So first of all, 90% of financial decisions are emotional, not rational. So let that sink in. Second is our primary research tells us that a majority of clients are willing to pay more. Think about this. We've just talked about fees racing to the bottom, but clients are willing to pay more for personalized advice. 3, those same clients say, a majority of those same clients say that my provider or my financial services firm really don't understand me. So it's not a great story, but there's a ton of upside, right? So I honestly think this is the next frontier of our industry, understanding people at the individual level versus the functional needs of a segment. For example, so today what we do is, let's say young couple getting married, right? They're like, oh, they're gonna need cash flow, they're gonna need liquidity, they're gonna need a mortgage for a house. Or someone thinking about retirement, we should think about nest egg, longevity, right? But particularly when it comes to retirement, it's a very emotional discussion. A lot of clients don't have allergic reaction just even thinking about retirement, let alone talking about retirement, right? So I just saw coming here today that there's a 99-year-old swimmer, Canadian swimmer, that's broken some swimming records in her age group. So maybe it's from 80 to 100, I don't know. So the way you talk about retirement to her has to be very different, right? It has to be purpose-driven. So it's less about, hey, you're going to outlive your assets. It's more about what type of legacy do you want to leave, right? So in order to have that conversation, you really need to understand the individual at the personal level, not as a segment that has certain functional needs.
Yeah, it's a very interesting point because, some organizations, segmentation, they would say, is probably not as important because they're working with a specific asset sector. So they're talking about somebody with a particular kind of risk tolerance. What you're saying is that the personalization goes far beyond that superficial level, and they're just not wired to do much about that.
Yeah, so I think this is where AI will be helpful, right? I mean, we see a lot of our clients, I talked about building the foundations for data. They're looking at many more sources of structured and unstructured data. They're looking at the quality of the data, like everything that's out there. There's AI that can read a lot more unobserved patterns and behaviors that a human can today, right? So when you think about serving that 80% that does not, receives more sort of one-size-fits-all kind of services today, AI will be able to do a much better job of, I know it's counterintuitive to think that AI can do something better than a human, but the AI co-pilot will be a great leap forward, I think, for our industry.
Yeah, I saw a commercial the other day, I believe it was Expedia, and the woman with a small dog, she wants to get to a place and have some sunshine, and that's all she asks the chat. And so it's interesting that what you're saying, the co-pilot is going to be actually warehousing an awful lot of those preferences that you've been building with all that data that you've been giving up to the world through the various interactions that you have. So it actually will be perhaps not smarter, but better organized.
Better organized, and it's just they have more capacity to understand behavior, and not only just the data, but even human emotions, right? In 5 years, our industry is going to look so different from it does today because of the vast amounts of data. Oh, one other thing, in our primary research, clients actually said they're more willing to give data, their personal data, to a financial advisor than to a doctor. So there's a level of trust in our industry, so we should take advantage of it.
Sure. Well, hopefully they're not just being hopeful. hopefully it's earned.
Actually, let me turn the questions to you. I know Next Chapter and you in particular have been working on some key trends for the 4 horsemen, as you call it. Why don't you share what those 4 trends are and what it means to our industry?
Sure. So I call it the 4 horsemen primarily with my short-term memory. I want to make sure I remember all 4 of them. The principal issue that we see in Next Chapter, and you have been a big part of this for the last almost 4 years now, is to understand the difference between something that is trending and what's really a trend. So in other words, don't get caught by something just because it's popular, but make sure that you're working with something that's causative. And that's what we are working with leaders to understand better, because something that's actually causative, that's the thing you want to keep track of, because the impact will continue to change. So trying to keep track of those impacts, I know is very hard for leaders, and I think it's much better working with them to be able to help them understand those causative trends, because their job is not to have the answer. That's one of the things that I think is so interesting, is that so many people feel like that they're leading a company, they have to have the answers. Your real job is to actually create the organization that is equipped to go out and find the answers. The real job of the leader is to create that team and then, of course, be able to supply the questions, because the questions are more formative and more sustaining. So we have found 4 that are just kind of perennially lingering in here that we have to take advantage of. And we did talk about those as Next Chapter at the Money Management Institute's annual conference, and MMI is of course one of our partners in sponsoring the show here today. So the first one is really more about stopping doing something. So it's the selectivity that's necessary. The underlying issue is that you can't be everything. Bull markets and strong economies allow you to make undisciplined choices. It looks like an easy thing to do or to add, but it's not really, because it is taking away time and energy from the organization. And an observation that we have, again, working with firms, is that if you do not stop something first, you will not be able to create the bandwidth and the dedicated resources necessary to achieve an objective. So I don't know how many times at Fidelity is a good example where we wanted to do something, but we did have the discipline to stop doing something else first so that we could focus on that. Because otherwise you have something that's done off the corner of somebody's desk, and it's not really a surprise that it doesn't achieve. We have 2 issues in that step of stopping. One is there are too many marginal products in an industry that doesn't need marginal product. Marginal product is very detrimental to an organization. For an asset manager who wants to be the worst performing portfolio manager on the team. I mean, it's not fun. So get rid of this thing that you don't do well, because it can actually impact your reputation, which is something I want to come back to, because I think reputation is a really, really important part of this consumer personalization, and it's going to pop up with the assistance of AI over and over and over again. You want to have a presence. But the other one, in terms of the 80-20, which you mentioned a second ago, Nalika, is that we spend way too much time on the wrong side when we are in that 80 or in that 20. Pick one. There are very, very few organizations that can put up a service model or a product set to work with the 20% of your very best clients. In wealth management, it's not really 80-20. It's more like 12 to 88 and something like that. We did a survey about that a few years ago. So if you look at that, the point is, don't try to provide a very high touch service as a value proposition if 80% of the clients are never going to get access to that. And that's primarily a capacity issue for the deliverer. But you used to be able to get away with that. I don't think that's going to work much anymore. And so on the service side, investment advisory side, it's being very, very disciplined about what you give the 80, because you can't afford to lose the 20. Because you're trying to spend time with the 80, which is not going to work anymore. So very, very hard decisions about what to stop. The second
Before
issue,
you go to the second, really quickly, look, I mean, that's something we find with our clients. Stopping something sometimes is harder than starting something
Sure.
new. And the reason is that when you stop something, you have to admit failure. And it's very difficult for executives to admit failure, right? So unless you have a culture of sort of the fail fast like tech firms, if you can promote that culture, I think the stopping becomes a lot easier.
Sure. So, it's okay to experiment. It's okay to say that the experiment was a failure. And it's okay to say the thing that we've had for 97 years that, started the firm just doesn't work anymore because it doesn't. So the second one is this, go back to something you said before, because I'll just pile on to that, which is the power of the consumer. Now, again, at Next Chapter, we're working with companies. We're just observers of what's happening, and we try to put that mirror back up to the organization and say, is this really what you want to be? And the consumer today is not only in charge, the consumer is getting more and more empowered for the reasons that we've already discussed here. A lot of confidence in consumers of financial services based on a lot of bull market activity. No one's ever seen any run like this, but if you've only been an investor for the past 13 years, you don't know anything different. And so they're going to keep running. In fact, I've heard more than once from advisors and from different service providers that today the biggest competition to a financial advisor is actually the consumer or the client themselves, because they have so much information available. And there are big companies that are supplying enough gear and insights and information for you to be able to do it yourself, or at least feel that you can. So it is so much important about what you said, Malika, about personalization. Personalization, when you need an advisor, more often means there's some trouble that I've encountered and I'm just not sure. But so much of this is about validating something that they already feel and then connecting them with the solution. And what we find in the financial services industry, and the advice industry too often, is that there's a failure to validate. So this is the thing that you ought to do. So it's almost like we make dog food here. We want you to buy the dog food, and that's just the way that it should be. I credit my Alliance for Lifetime Income friend, Mike Harris, for that comparison, which he uses frequently to keep us on the ground. So the consumer is there. Consumer's not going away. So how will the consumer be present in your organization? And how will you show up for the consumer as part of what I'm saying? We're seeing an awful lot of value in being able to provide content to consumers. We've got a fantastic partnership with Advisorpedia, with founder Doug Heikkinen. We have got all kinds of stuff that says people are searching for information, and they are living now in the same areas that financial advisors and industry decision makers are. So let's break down the walls. And so one of the ways to actually show that you are consumer friendly is to get rid of everything that's in the way of people trying to get access to your content. This industry is filled with brilliance that is walled off behind some artificial paywall or cookies or something, and that's just not consumer friendly. So I think the final part is, if you were to ask a big company, who's the chief customer officer, and they show you the national sales manager, I'm not so sure about that. But I'd actually look for your comment. Our friend Kathy Murphy, who will be up in a second, used to be the president of personal investing at Fidelity. One of the things she says is that companies have been organized basically the same way in this industry for the past 40 years, and it's time for a refresh. Actually, I think she says 80 years.
Yeah, even think about how we segment clients. We touched on it earlier. It's based on assets under management or source of funds. It's still very focused on the numbers side of it, not the emotional needs of the consumer or the customer, right? So I think that's the pivot that we have to make as an industry.
Sure. So number 3 would be, I guess the best way to say it is retire that salesperson in you. There is some really interesting research we talked about at MMI in Austin, Texas, back at the annual conference, that shows that people are actually evaluating their relationship with products and services based on the process they go through to acquire them. So in other words, the sales process itself becomes as important or more important than the product or service. That, I think, is remarkable, but it speaks again to, I guess, what you might use as the best analogy for that would be the car buying experience and how it disenfranchises all kinds of people and different groups of folks over the years, and being able to try to make that a simpler and more inviting opportunity is almost enough to drive somebody to a different car. I actually could get that. It's a little harder to see in our industry, but when you are trying to get ease of doing business, clarity, And people think they've already given up all kinds of information. As you said, Nalika, they're concerned about that. If they catch you doing it, you're in trouble. But the idea is to be able, again, to show that you are truly customer friendly so that it is not really something they feel like they bought. They feel like you kind of joined in a partnership.
Yeah.
So
there's some interesting examples from insurance outside of our industry. There are some insurance companies that are piloting AI straight-through processing for claims processing. So you get into a small accident, all you have to do is take a picture and upload, and then the check is in the mail. That's it. Everything else is supported by AI, right? So why do you today have hundreds of people sitting in service centers, calling the client, having the client fill multiple forms to cut them to check, right? I mean, so it's simplifying, goes to your point on the process, right? If the process is easy and it's a non-process, it actually improves the client experience and loyalty and stickiness.
Yeah, absolutely. Absolutely. I mean, again, automobile industry has done an awful lot of things crazy over the years, didn't really understand the boomers until it was way too late, lost half their domestic market share. But some of the things that they've done in the meantime have opened the doors at other firms to be able to fill those gaps. And I think that's one of the things, of course, that you see a lot. If you open up a gap in here and in something like a sales process, that's an exploitable gap by a competitor. And those don't stay open for very long. Mm-hmm. So I think it's a very interesting thing. The final one is, of course, probably our lead dog in the whole next chapter work, which is longevity. And I'm not talking about retirement, I'm talking about longevity. Retirement is kind of a cool extended vacation that you're going to have at the end of your working years. You fantasize about it for decades, and then it arrives. And that's great for a while because you have the most money you're ever going to have post-work and the best health you'll ever have probably post-work. And then something changes. So if our friend Frank McAleer was here from Raymond James, who's been working with Next Chapter since the start, if he were here, he would say, it's really about peace of mind. How am I going to have peace of mind in this period post-work? And again, it's not so much that we can't go on vacation or we can't do the things we wanted to do. It's that particular world does not stay that way. So we talk a lot about retirement in trimesters. The first trimester is the sort of go-go and you just can't wait. I've been waiting for this for years and we're off. And quite literally, sometimes we're off. And then you get that second period where if it was a couple, one of the people is not as robust as they were. And so they can't move as quickly, can't do as many things. And now it's different. And so that sort of go-go period is then replaced by the slow go period. And that slow go period is where the reality of longevity arrives. Longevity, this unprecedented longevity, like our Next Chapter board member Ken Dykewald reminds us all the time, is there's a lifespan, but there's a health span. And what I'm talking about here is that health span, as it comes to a close, does not even come close to the end of many people's lifespan. So when we think about longevity and preparation for longevity, we are lined up, I think, with those consumers that are experiencing those trimesters, if not themselves right now, they're seeing it through the eyes of their parents and other relatives. So being prepared for longevity is not being prepared for retirement. It's being prepared for how long you're actually going to live. And as clients slide into that slow go, and then of course the kind of no-go phase, when my father passed away, my mother would say she was in that no-go phase, except she has always been a go-go person. So that she's going to be 90 next month and she's still trucking along. But I think the whole point of it is that we're trying to help support longevity. And for people, that's a very different kind of objective. Retirement is sort of a happy sounding thing, and it's
for some people, not for everybody.
Exactly. Well, I can come back to that. So there are people who are in really good shape for the concept of retirement, and then they get farther into it and they start realizing how difficult it is. So this year we celebrate Peak 65. Jason Fichtner is going to be with us in a few minutes. He's going to talk about that. who is working with us at the Alliance for Lifetime Income as the head of the Retirement Income Institute. And that Peak 65 work that the RII and the ALI have delivered is really, really important stuff. More people turning 65 in the year 2024 than ever before. That's not a flashpoint in time. That's a spot on the progression of a trend. And so longevity is going to be with us for a long time. And kind of simplify the approach that we would suggest we begin with here at Next Chapter. First, we have to normalize longevity. We've sort of normalized retirement, but as a desirable thing. And longevity is not necessarily what people want to talk about. As you mentioned a second ago, there's an awful lot of stuff that people want to talk about retirement. The longevity aspects of it are hard, even for the people who want to engage, because it's scary. You know, longevity occupies that spot between the retirement and vacation and when you die.
And the slow go and the no go.
Yeah. And I've actually had in my very, very early years as an advisor, I've got a couple of stories of people hearing me talk about the slow go and the no go and standing up, thanking me very much, and walking right out the door. So we'll also hear from Tom West today, who you know is an expert in this area. He's got some thoughts to share as well. So also in the area of longevity, I'll bring this to a close and get Kathy Murphy and John Thiel up here in a second, is that this longevity topic has got to be actualized. We have to help the clients do more. We have to figure out how to support advisors to do the right kind of stuff. But one of the things that we're battling is the gear ratio or the coverage ratio of the existing financial advice business. So when we look across all these different models, and you folks are the experts in this, whether it's a private bank or a big a high-touch RIA, family office, or even one of the big box stores, when you blend that all together, the advisor to client ratio just doesn't work. Way too many clients, something like 150 households per advisor, and you can't deliver against the complexities of longevity planning.
This is where the AI co-pilots come into play.
Mm-hmm. So we'll be talking a lot about that. And again, Frank's working on it. Frank McAleer at Raymond James, we're working on that. Ken Dykewald, lots of other people. And so, tap into that because there will be more and more. So what I want to do now, I'm going to transition. Now, a couple of guidelines for you here today. If you have to step away, worry not. All of this is recorded by you being a registrant for this program. It will be made available to you, and you will see an email later on, actually a couple of emails that come out that will tell you how to get access to that. If you have questions, put them in the chat. We're going to let these folks that we've pulled in for these sessions, we're going to let them do their thing and just kind of rip it up. So we're going to hold the questions to the end. So if you put the questions in the chat, we're going to actually answer those and come right back to you directly, so that if you want to talk about it, that'd be great. So don't hesitate to put in questions, but know that they're not actually going to come in at the same time. So without further ado, I want to thank you here for joining me here today on the 48th floor of Manhattan West. I think actually the sun has come out, which should be, that's a harbinger of today. And who I want to tee us up today first with our first session. These two people are great friends of ours. We think that they are a fantastic duo, because even though John Thiel and Kathy Murphy were arch competitors, John managing wealth management at Merrill Lynch and Kathy Murphy running the retail business, the personal investing division of Fidelity for so many years, and what a tremendous story that was, 700 billion to over 3 trillion and now 41 million clients. They have very different business models, yet they have an awful lot in common. And I think you're going to see that in this conversation that I had with them just recently.